Good morning, everyone. Welcome to a CRI webinar session. Today's session is titled COVID CARES Act and how to account for it and pass the single audit. We're excited about today's presentation. We have some great presenters for you today. Just go through and explain our, start off with, if anyone has any questions, you'll notice in the GoToMeeting kind of control panel, there's a questions tab. Feel free to, at any point during the session, you can ask questions. We did include a question option in the registration process, and we did get some good questions. And at the end of our presentation, we're going to have what we're going to call an office hours little period where we'll go through some of those questions. But if during the presentation today, some questions come in from the group that we feel is best to answer, to clarify a point, we'll answer those as we go. So please feel free to post your questions throughout today's session. So my name is David Alvarez. I'm going to be the moderator for today's webinar. I'm calling in from frigid Tampa, Florida. Frigid means, for those outside of Tampa, anything under 60, we are dolled up in fur and gloves. So that's where I am, and I'm a government audit partner, and it's where the majority of my practice is. Our first presenter today will be April Shuping. She's a government partner out of Gainesville. She's extremely knowledgeable around the CARES Act, and in addition to auditing, she's been doing quite a bit of consulting work around CARES Act and CARES Act compliance issues that the CARES Act has brought out. Our second presenter is Brian Hall. He's our healthcare line leader. Brian's included today because we're also going to be talking about the provider relief funds that's included as a part of the CARES Act. So in Brian's portion, he'll be covering some of those specific topics that address the provider relief fund. You'll hear us use the term PRF quite a bit, and that's the provider relief fund. And then we also have Gwen Mansfield-Vogt. She's our firm-wide single audit specialist. So all single audit questions, she gets a lot throughout our firm, and those all will end up funneling through Gwen. And we have Gwen today, and she'll be covering real specifics on the single audit issues that the CARES Act has brought up. So today's session does qualify for CPE, qualifies for 2 credit hours, and there's 1 credit for every 50 minutes, but I will just want to be clear that there is no partial CPE, so you have to attend, you have to be on for the entire session, and we'll have some polling questions, and when those polling questions come up, it doesn't matter if you get the answers right or wrong, it does matter if you respond to them. So that's how the NASBA and we track CPE participation. You need to answer a minimum of 80% of those polls. And each person, when you registered, received a registration link. Those links should not have been shared. So those links are individual to each person. And it kind of goes back to us being able to track the CPE. So you should be using your own link for CPE credit. If you are on someone else's, you'll get a great presentation today, but unfortunately you would not be able to receive CPE. CPE certificates will be distributed within 7 days. Usually it's much sooner, but maximum 7 days. You'll get your email, and that'll come from the email address here, certificates@simplescert.net. And if you have any questions about the certification process, you can reach our marketing department, who does a great job managing these sessions, so you can send them an email. I'd also point out that the slides are available for download. Back to the GoToMeeting control panel, there's a little button there that says handouts. If you click on handouts, you'll see the PDF format of the slides for you to be able to download. Also, within the next day or so, these slides and the video audio recording of today's presentation will be sent out to everybody. So you'll have that for your reference going forward. We have one first poll. This doesn't count in the 80% of poll questions, but just a little bit of informational kind of background. We're going to kick off one poll question here, just your purpose for attending today's session. So if you can go ahead and answer this, we'll give it just real quick to get responses in to see why people are attending today's session. So if you could click on the yes or no button on your screen. So we're just about there on, looks like most everyone has answered. So I think we'll go ahead and move on. Then we're starting with the today's agenda. And I will again point out that we're talking about the CARES Act. The CARES Act included a bunch of different sources of funds. There's a lot of pieces of the CARES Act. In the, kind of backing up before we really get to the provider relief funds in the government space, the CARES Act and the Coronavirus Relief Fund were kind of used in the same manner. But just want to be clear that the CARES Act is the overarching $2.4 trillion act. It included a bunch of different pieces, and we're going to be talking about two of those pieces today. But you'll see separate, we'll have separate information both about the Coronavirus Relief Fund and the Provider Relief Fund. So we'll then get to, really today where we're going to get into some detail is, how do we record that revenue, and in what period does that revenue belong in? We have a lot of funding sources are kind of straddling balance sheet dates, so straddling fiscal year end. So we'll talk about what period to record that revenue in. And then really these last two bullets are all things single audit. Does it apply? And if it does apply in this specific circumstance, what are the rules? What is the general guidance and rules that are going to apply to those funds? So we're going to kick off. We're going to start off with April, and this is her first slide. So welcome, April.
Thanks, David. Good morning, everyone. I'm again April Shuping from the Gainesville, Florida office, where it's also quite cold this morning. I think it actually froze last night. Welcome everybody. I'm excited to talk about CARES Act. It's what I've been breathing for the last 6 months. So we'll jump right in. So what even is it? David alluded to that a little bit in his introduction. It's lots of different funding. Today we're going to talk about these two types, the Coronavirus Relief Fund, CRF. And if there's a slide in this presentation that just says CARES Act, we are saying CRF. That's kind of our natural default of the CRF is just kind of called the CARES Act colloquially throughout government organizations. So that's the money that went to our states and large local governments. Smaller local governments typically got that money through the state. I believe school boards, it also came through the state to school boards, and tribal organizations got it directly from the federal government. We also had provider relief fund monies. These generally went to healthcare organizations. Some of those may have been governmental owned, not-for-profit or for-profit healthcare organizations, and all different types, hospitals, doctor's office, nursing homes, Indian Health Services, pretty much anybody who's helping out people with their health was eligible for some of these provider relief funds. So just keep in mind as we go through the slides that we're talking about two different pots of money. And if we don't specify PRF, we're talking about CRF. So is it a grant? So here we're talking about the CRF, the CARES Act funding. We'll talk about the PRF a little later in the webinar, but the CRF is not technically a grant. It's other financial assistance. So what does that mean for your purposes? Nothing. It's the same thing. It's subject to all the same things as a grant. It's just a technical classification at the federal level that is other financial assistance and not a grant. For accounting purposes, GASB 33 is going to really be one that we're going to heavily lean on for how to do the accounting for these funds. And it says we want to follow the substance of the transaction, not the form. So it doesn't matter that they're not calling it a grant. There are some eligibility requirements in the CRF money. You have to be a government to get it. And really to get it directly, you had to be a certain size government. There's also an option to accept or reject the funding. You don't have to take the money. And that means that what we're going to call this money when we start thinking about how do I account for it, our fiscal year is closed, we got some before, some after. We're going to consider this a voluntary non-exchange transaction. For those of you who are not governmental accountants or auditors, this is probably gibberish to you, but if you're operating in the government sector, this should sound familiar. It's some of the terminology in GASB 33 that gives us the ideas and the scaffolding for how we're going to structure the accounting for these transactions as we cross our fiscal years. So voluntary non-exchange transaction with some eligibility requirements is what it really is.
So we actually have our first polling question. So this one does start our CPE credit. So if everyone can go ahead and answer this question. And this one first is just informational. So do you work for or with an entity that has received or is expected to receive CARES Act funding as financial assistance? And if you could please answer yes or no. So I would generally think most governments will would be in the yes side. So maybe that's just part of maybe the makeup of our audiences today. April, I'm not seeing if you're seeing many governments that have not received at least some, at some point, some CARES Act funds.
Yeah, most governments either got it directly from the state or in some level of subrecipient drop down. Some of them got it straight from the federal government or through their state, or if you're a municipality, for example, in Florida, you would have gotten it through your local county who may have gotten it through the state. So it could be multiple levels of subrecipient drop downs, but most local governments should have received some of this funding if they wanted it.
So we're just about 90% voted. Just give it a couple more seconds. And let's go ahead and close out and go ahead and move on. Just for everyone's, we had about 81% said yes to this question.
All right, so now we've talked about what it is. So how do we decide what am I recognizing as revenue? Does it matter if it was an advance or a reimbursement? And we're going to go through kind of how GASB has given us some guidance on this. So we're going to start with general guidance on grant revenues overall, and then we're going to drill down into the CARES Act. So generally, GASB 33 is what's going to tell us how do we recognize our revenue. It defines these different types of non-exchange transactions, and I'm not going to go into great detail on this because we're really only talking about the bottom one, the voluntary non-exchange transactions. It's where most grants and donations fall, and that's what the CARES Act is defined as for our governments and any entity following GASB who reports under the governmental standards.
Oh, sorry, we have our second polling question. It came up quick. So our second polling question, which GASB standard addresses non-exchange transactions and provides useful guidance on how to record revenue associated with coronavirus relief funds? And just for one, just quick update, some of these polling questions based on a system limitation within GoToWebinar, GoToMeeting, some of them might have to be condensed once we launch the poll. So the wording might be slightly different, but possible answers on GASBs. So have a 25% chance. April just covered it. So is it 32, 33, 68, or 95? This is more just a test, April, to see who's paying attention, because
This is the paying attention test.
Doesn't really matter.
And again, you don't have to get it right. So especially those of you who are not governmental accountants, don't angst. This is just vote for the credit, and we'll hit the stuff that's more relevant to you soon. But it seems like most people are doing really well on this one. And fast on the draw, you guys are voting quick. That's great.
We'll give it just a little bit more time to make sure everyone gets a chance to get their CPE. Okay, so the actual answer is GASB 33.
All right, so now we know we've got a voluntary non-exchange transaction and it's following GASB 33. So what does GASB 33 tell us other than the type? It tells us that we're going to recognize revenue when all eligibility requirements are met. And so that's a really vague term, eligibility requirements. What does that even mean? Well, when you think of grants, we have different kinds of requirements tied to our grants. If you've listened to me speak before, you know I get on a little bit of a soapbox about certain GASB things I don't agree with, and this is one that I think could be a lot clearer. But GASB says there are some stipulations on use of funds, some of which are eligibility requirements that guide revenue recognition and some of which are not. A time requirement, GASB considers to be an eligibility requirement. If you are not allowed to use the funds until October 1st, and your fiscal year ends September 30th, it doesn't matter whether you've been awarded a grant, got the cash in your bank account, you've not met the time requirement for that eligibility. It's really your period of availability to use the funds. And so a time requirement does drive revenue recognition. However, and this is where I think GASB gets a little unclear in how they provide their language and guidance, a purpose restriction, you must use these funds for this purpose, does not affect when we recognize the revenue portion. And so really differentiating what is a purpose restriction and what is a reimbursement grant that's driven by expenditures. They can feel really similar. And so defining, because that purpose restriction doesn't guide when we recognize revenue. If you are given an entitlement grant, say as a government run college on an FTE basis or school district on an FTE basis, that you can start using the funds at the beginning of your fiscal year, you don't have to actually have spent those funds to recognize the revenue. You just have to have met all your eligibility requirements. However, if you get that same exact grant, but even if it's an advance, but it's based on how much you spend on a specific purpose, that does affect revenue recognition. So time requirements and purpose restrictions are two types of fund use restrictions, but what is defined as a purpose restriction is not considered by the GASB to affect when we recognize revenue. And this is all going to build up in the next 2 to 3 slides that'll really fall then into place into CARES. So these eligibility requirements that the GASB says, you can recognize revenue when they're met, that you have the characteristics specified by the provider. You are a local government, you are a school board, you have a certain number of students enrolled, you have time requirements that have been met. You're allowed to start using the funds on the state, your period of availability has started and not yet ended. Those are eligibility requirements. And again, remember, eligibility requirements drive revenue recognition. For a program that has resources on a reimbursement or expenditure driven, even if it's an advance, you can get an advance that's expenditure driven. You have to have incurred the allowable costs to recognize revenue. So this is where GASB says, regardless of the methodology of the funds coming to you, advance or reimbursement basis, if they're expenditure driven, that you will only earn them as you spend them. That's an eligibility requirement driving revenue recognition. And then also for any voluntary non-exchange, if there's any contingencies, the provider has stipulated that you have to file a report, or they meet at least 90% graduation rate for a school district. If the provider does that, you must also meet those eligibility requirements. So these are the things that drive when we recognize revenue for voluntary non-exchange transactions. So how do we pull that all together? So when we're looking, and again, we're really narrowing down on the voluntary non-exchange transactions because we're talking about CARES, CRF funding. And again, this is pretty important to differentiate between PRF, which is an entirely different revenue recognition process. But for CRF funding, the one that the government's got, that funding is going to be the voluntary non-exchange. It is going to be recognized when all those eligibility requirements are met or resources are received. That's when we book our asset. So if you get the funds in advance, you're going to book your asset when you get it, right? You book a receivable if you've met your eligibility requirements in advance of receiving the asset, right? So that side's pretty simple. On the revenue side, however, you have to have met all of the eligibility requirements to record it at all. And we'll go through, I think it's after the next poll question, we're gonna go through some very specific examples. I think that'll make this a little clearer. Again, I'm not in love with how GASB wrote this particular standard. And then we have to always remember on the revenue side, if we are doing fund statements that are on the governmental, governmental accounting fund statements on a modified accrual basis, you've got to consider your period of availability for your revenue recognition as well. And again, I think I learn best with examples, and so we'll go through a few examples that should hopefully make this a little clearer.
Okay, so we're going to go on to our next polling question. So polling question number 3. For most governments, CARES Act funding is classified properly as an exchange transaction, a government mandated non-exchange transaction, a voluntary non-exchange transaction, or the technical GASB term giant headache.
And for the record, there are 2 correct answers to this question. So we are accepting 2 answers to this one.
So I do think, in all seriousness, getting the terminology right, I think just the main benefit is, in anytime we're talking about, well, how should revenue be recorded? If you're ever going to look up kind of answers or, kind of Google an answer, because there's actually some great information on Google about even governmental accounting. If you have the initial terminology right, it makes the answer so much easier. So I do think there is a benefit in at least knowing kind of what the term is.
It does, and I think it does help a little of standardization of practice across governments when you have, even if they're bizarre language that the GASB chooses, those clear definitions that this is this thing definitely does help. I know I've done a ton of Google searches in my career as a governmental accountant and auditor. And yeah, you can pull up all kind of great presentations and articles just with that right terminology. It does help guide that a lot.
So the actual correct answer is a voluntary non-exchange transaction. Giant headache is always true, but the correct answer is voluntary non-exchange.
Okay. So GASB goes on to talk about entitlement and shared revenues. And these are the ones that's the nuance that I think it's really sometimes hard to draw the line. And when we were thinking about how will we account for these CARES Act monies, figuring out if it's an entitlement versus a expenditure-driven grant is really the line that we had to figure out which side of the line is that on, because there's some shared characteristics between both. So entitlement is based on a formula with purpose restrictions on the money. And if you think about CARES, I think there actually could have been an argument that that's the case. The money, there was a big pot of money. It was given out to states and other entities, probably based on some, there was some formula, and I didn't research to figure out what it was. I guess population, but who knows, that the federal government used to allocate this big pot of money across different governments. They didn't apply for it based on needs. It wasn't that kind of like, I want to build a road for $1 million, here's my application. It was, we've got some allocation method and we're going to sort this money out across all of the agencies that are eligible. So I think there could have been an argument that this was an entitlement grant. It's not where we landed. Then the GASB ended up giving us some very clear guidance on that. But without that guidance, I think this could have been a really confusing area to figure out what side it landed on. So a formula grant is something like you have 10,000 students in your district, we're giving you a certain dollar amount per student to spend on educational purposes for the year. That's an entitlement grant. You're getting it, there's a purpose restriction, but it's not expenditure driven. You may have to give the money back that you don't spend at the end of the day, but it's not, or the end of the school year or 2 years down the road, but it's not considered an expenditure driven grant. In the case of an entitlement or shared revenue grant with a purpose restriction, if you get those funds in as an advance prior to meeting an eligibility requirement, and again, that eligibility requirement may be having a certain number of students enrolled in a college, or typically what we see, it's a time requirement. So our example is a time requirement. So if I'm a small city, I got a formula-based grant that I'm not allowed to spend until 2021, but I got it in 2020. The money came to me in advance. I can record that asset. We record it when it's received. Remember that earlier slide? It's when the eligibility requirements have met or the funds have been received. So now I've booked my cash as a debit, and then I'm booking a deferred inflow because what hasn't been met yet is a time requirement, and that's an eligibility requirement. And so my credit is going to go to deferred inflow until my fiscal year 2021 starts. At that point, I've met that final eligibility requirement of a time requirement. I'm going to eliminate my deferred inflows but with a debit, and my credit will then go to revenue. So at the end of the day, I'm going to have an asset, cash, and revenue. In that prior fiscal year, because I booked a deferred inflow to offset my cash, I don't have any equity generated to worry about restricting. Once I've met my eligibility requirements and I've reduced my deferred inflows to zero, now I have revenue, a credit to revenue. Now I've got equity, right? I've got cash and revenue, generated equity, because until I've met all other requirements, and it may be generally things like spending it on students, any equity that's remaining that has restrictions from that third party is going to be shown as restricted equity. When I've met those purpose restrictions, and remember, purpose restrictions are not eligibility requirements. GASB keeps those separate. When I've met those purpose restrictions on the entitlement grant, which is spending the funds on the required program, all I do there is release that restricted equity, because really the equity's gone. I've spent the money. So it's in some ways releasing the equity. It's really eliminating the equity generated by that advance. So that's how this is not how we account for CARES for CRF, but this is just if we had not gotten guidance from the GASB specifically related to CRF, there could have been a strong argument for accounting for it this way. So again, another if that award is allowed to be used over multiple fiscal years, same thing, right? That's an entitlement grant. I can use it over multiple fiscal years, but I'm not required to spend one. And it's not like you have to spend a third in this year, a third in this year, and a third in this year. You don't need to defer anything. In the state of Florida, SHIP grants are a good example of this. If it's you have to use, we're going to give you the money in advance, but your eligibility requirement of an availability period is split into 3 different fiscal years, you would defer the portion you got in advance until that eligibility requirement would be met. You'd almost treat it like 3 separate grants for accounting purposes based on those eligibility requirement of the period of availability. And if you're getting through an entitlement grant, say you've got in Florida SHIP money, and you are getting really close to the end, and you know you're not going to be able to spend it down, and you're going to have to give some money back. And it's multiple years like that, you're going to actually book an expense or an expenditure depending on the fund you're recording it in or the government-wide, and a liability because you have to return it. Now, that's something I've never seen in practice. Governments are pretty, and I worked for government for about 17 years of my career, so this is self-deprecatory. We were good at spending money. It's what, given it to us to give to our citizens. Governments are pretty good at getting that money out there. So I haven't seen that in practice, but theoretically, according to the GASB, that's what you do. All of that is to say, we don't do any of this for CARES Act for the CRF funds, but it certainly was a methodology that could have been used if we hadn't gotten guidance. And if we look to the future of more funds coming down from the federal government, which is not unlikely, you know, it'll have to be evaluated again based on the legislation surrounding those restrictions. And hopefully GASB will do a great job like they did on this one of giving very specific guidance because it's such a large revenue source.
Okay, so we're coming up to another polling question, number 4. Formula grants advances received after all eligibility requirements are met, except for a time requirement, would be recorded with the options are debit to liability, credit to liability, debit to deferred inflow, or credit to deferred inflow. So get those T accounts out and let's see where we end up. April, I know you were saying there's some issues that you have with GASB. The deferred inflow outflow is one of my biggest pet peeves.
That is definitely, and I hope nobody from GASB is on the webinar, although this, I am not a surprise to them, my personal opinions on this. But this is I teach a governmental accounting class at a local college, and my students every semester are subjected to about a 20-minute diatribe about the fact that GASB didn't think assets, liabilities, and equity were enough. That somehow we, you know, those 3 basic things that I think have been around since, I say the Phoenicians because I love Epcot, at, you know, the Spaceship Earth at Disney World, or we think the Phoenicians for the alphabet, but I assume they did double entry bookkeeping too. But my GASB said, no, this is a basic human concept of plus, minus, and equals. We need some extra ones. So this is definitely one of my pet peeves, is deferred inflows and outflows.
So kind of a hint for the question to get deferred inflow in that answer. So now we're down to like a 50-50 if we were on Who Wants to Be a Millionaire. So we're almost at 80% voted. Just want to give a little bit more time to make sure everyone votes to get their CPE credit today.
And remember, you don't have to be right or wrong. That's all just for personal bragging rights at the next GFOA conference. But just to get CPA credit, just push a button.
Okay, so the actual answer is credit to deferred inflow.
Because what you're debiting cash. And so instead of crediting a revenue, you're crediting it a deferred inflow, which is GASB's, I don't know what I'd even call it, category for things that are like liabilities but aren't exactly liabilities. So. Okay, now we're getting into what GASB has said the CRF CARES Act funding is. And this is probably, those of you who work with grants or governmental accounting, these are the kind of grants, when you think of grants, these are probably 90 to 95% of the grants you get if you're in a general purpose government. Most grants are expenditure-driven grants. And expenditure-driven grants are, I need this much money for a project, government or some other grantor is going to give me some percentage of that, and I earn it as I spend it. And again, I think there's a very fine line nuance between this and purpose-based restrictions, but most grants fall into this category. When I have an expenditure-driven grant, regardless of whether it's an advance or a reimbursement, because that doesn't matter at all, reimbursement grants can have advances in them. You're going to recognize your receivable and your revenue once the period of performance has begun. That applies equally to this. You only book those as you spend the money up to the maximum of that you've been awarded. And that's assuming all other eligibility requirements like the period of performance are in place. In general, you don't get the grant until all that happens, but you do have to have all your other eligibility requirements met. At that point, you book a receivable. If it's a reimbursement grant, you book a receivable and a revenue as the allowable costs are incurred. You're not eligible, the spending of the money on a certain purpose becomes an eligibility requirement for GASB under this, whereas in a formula-driven grant, the spending of the money is not an eligibility requirement. It's a purpose restriction. And so again, strange little nuance, but most grants fall under expenditure-driven grants, and you don't book the revenue till you spend the money, regardless of whether it's an advance or reimbursement-based. If it is an advance and I get my money in advance, that is not a deferred inflow, that's a liability. So I believe unearned revenue. So if I get a cash advance before I spend any money or spend all the money, I'm going to debit my cash. We always book the cash when it comes in. There's not any other option. And so my credit then is the liability of unearned revenue until I've met all eligibility requirements. And remember, in this case, the eligibility requirement is spending the money is certainly one of them. As I have met my eligibility requirements and start spending these funds on allowable costs, my entries are going to be to debit that liability and credit a revenue as I spend that down. Again, the eligibility requirement is spending the money in an expenditure-driven grant. All right, so what does that mean for CARES Act funding? So for CARES Act funding, different governments got CRF money in different ways. Large governments, states, and very large governments over a certain population threshold got the money directly from the Treasury. And those governments got all of the money as an advance. If you're a smaller government or mid-sized government that didn't qualify for direct funding from the Treasury, you probably got it either from a higher level of government, the state, or a higher level of government like a county or a parish. You know, there's different terminologies for those kind of umbrella governments and certain entities. So you probably got it passed through to you, and that may have been as an advance or a reimbursement. Or both. In the state of Florida, the second tier recipients got the first two phases as advances and the third phase as reimbursement. So it could even be mixed depending on the state you're in and the size of the government you're working for. So if you got an advance with CARES Act money, we have a technical bulletin that GASB did, and I really, as much as I criticize them for lots of things, I think this was really forward thinking, and I really appreciate that they did this. It's very clear and direct and timely. They issued technical bulletin 2020-1. And if you haven't looked at that and you're responsible for doing auditing or accounting for this money, I recommend that you go take a look at this. It's a great resource, and it's pretty short. It's really in an almost implementation guide format with questions and answers. So this is what really drives how we're going to account for CARES Act funding. So that first question, question 1, states that the incurrence of eligible expenditures is an eligibility requirement, not a purpose requirement. So now all this lecturing I just did on GASB 33, that's why we need to know those words, because this is now telling us, oh, okay, now I know it's an eligibility requirement, which drives revenue recognition, not a purpose requirement, which doesn't. That tells me this is not considered entitlement funds or shared revenue. This is considered an expenditure-driven grant, regardless. And again, GASB 33, we follow the substance, not the wording. And so we're saying, okay, it doesn't matter that you got it as an advance. It doesn't matter that if it was allocated based on a population basis. What matters is it's an expenditure-driven grant, and that means all of our revenue recognition is going to be driven by that. Because the incurrence of eligible expenditures is an eligibility requirement, we are not going to record revenue regardless of when the funding comes in until all eligibility requirements are met, including the incurrence of eligible expenditures. So now we're saying, okay, doesn't matter how I got the money, I cannot book that revenue until I have spent it on something eligible and met all my other eligibility requirements. That also means when you know, a couple slides back, if I've gotten an advance, that advance is I'm going to have my cash as my debit. I'm going to credit the unearned revenue liability until I meet those eligibility requirements, including the expenditure of the funds. So if my fiscal year end was June 30, I got $1 million before that fiscal year end, but I didn't start spending it on eligible things until the next year, I'm going to have a debit to cash of the $1 million and a credit to my unearned revenue liability for $1 million until I start spending that money. Once I have met that all my other eligibility requirements are met, and including in spending the money on something eligible, now I start reducing that liability and booking my revenue. So this is, if you get one slide of the whole presentation and you're responsible for CRF funds, again, remember this is for our local governments, school boards, things like that. CRF funding, not PRF funding. This is a really important slide to drive how you're going to book your transactions. Now, what if I got it on a reimbursement basis? So that's even simpler. If your state or your overarching government, if they say you're the third or fourth tier recipient, if you got it on a reimbursement basis, that's even more clear. That's an expenditure-driven grant. It's an eligibility requirement to spend the funds. If as you spend them, you'll book a receivable and revenue as long as you've met all eligibility requirements. And then when the money comes in, you just reduce your receivable, debit your cash like normal, any other grant. The one thing we need to consider for if you did receive it on a reimbursement basis, don't forget your period of availability for the funds. I know in a lot of state of Florida is requiring a ton of documentation if you're a subrecipient of them for these funds. And so on the reimbursement side, they may not be giving you the money within your period of availability. If you're a 930 you're in government, that period's long gone for most governments to recognize this. And in that case, in your governmental funds, you're going to have a deferred inflow, just like you would for any other grant that came in late. And it'll be a reconciling item to your government-wide, because it'll always be considered revenue in the government-wide, regardless of when the funds come in. But in your governmental fund statements, you may not be able to record it as revenue in that last fiscal year if the money didn't come in within whatever your defined period of availability is.
So we have another polling question. So we received CARES Act funding in a mix of advances and reimbursement-based draws. Does the timing of the revenue recognition depend on the type of payment, advance versus reimbursement request? So yes, no, or no unless the period of availability is exceeded in governmental funds. So a little bit trickier question here.
And interestingly enough, for those of you, and this might be a tiny hint, interestingly enough, in the GASB's preliminary concepts on the new reporting model they're working on, they actually get rid of the concept of period of availability. They unfortunately keep deferred inflows and outflows and all other kind of nonsense, including this bifurcation of how one accounts for grants depending on whether it's an entitlement grant or a expenditure-driven grant. That's still in there right now. But the period of availability is actually being dropped out of the new governmental reporting model in the preliminary views. So it's an interesting thing that they're doing there.
So I would say, since April is mentioning period of availability, that might be a hint on the correct answer here. Could be. You want to interpret it that way.
Or the fact that David's saying that I said it could be another hint.
So April, we're at about 78%. So I'll give people a little bit more time, but based on the answers that are coming through, it seems like there's some confusion on this question. So if you want to explain it a little bit.
We're seeing a lot of yeses. And so the timing of the asset recognition, that does depend on the type of payment. The advance versus reimbursement. If you get the cash, it's cash. You may have to have an offsetting credit to it that's not revenue, but revenue recognition does depend on the type of payment, advanced versus the timing of that revenue recognition. Does not depend on it. Whether it's an advance or a reimbursement doesn't matter when you recognize the revenue. You recognize the revenue when you spend the funds and meet all the eligibility requirements in this type of grant. So, so the question probably could have been a little clearer because we, really it's focusing in an expenditure-driven grant. In an expenditure-driven grant, the timing of that revenue recognition will not depend on whether it's an advance or a reimbursement request. It's always going to be recognized when all eligibility requirements are met. And in an expenditure-driven grant, one of those eligibility requirements is going to be spending the funds. Getting the money doesn't matter for the time unless you're a governmental fund and you have that period of availability. So
the correct answer was C.
Yeah.
So we're going right back into another question. So reimbursement grants received after year end and after the availability period should be recorded as which of the following in a governmental fund? A revenue and a receivable, a revenue and a deferred outflow, a receivable and a deferred outflow, or a receivable and a deferred inflow. It's like we're taking the CPA exam again here.
So here we're saying it's an expenditure-driven grant that's a reimbursement basis. I got the money in after year end, but I also got it in after the availability period. So do I get to book a revenue? And I'm in a governmental fund. Do I get to book a revenue? If that yes or no, we'll drop that really quickly into a 50-50 chance. Do I get to book a revenue, yes or no? And then what else am I booking? Am I booking it as a receivable, or does it get to go into one of GASB's new deferred inflows and outflows? So the answers are coming in pretty clear, and you don't get credit for getting them right. So I'm just going to talk through the logic on this while you're voting. So feel free to keep voting. Or so we've got money that we spent. We haven't been paid yet. So if I've spent money and I haven't been paid, I'm going to have a receivable. So I know I'm going to have a receivable. So I can get rid of B. I've got a receivable. Do I have a revenue? Well, I got my money. It's a governmental fund, and I got my money for it after the availability period. So no, I know I don't have a revenue. So now I'm down to the last two questions. It's a receivable and a deferred outflow, or receivable and a deferred inflow. And because GASB names things in the most complicated and hard to figure out way, if you're like me and you get deferred inflows and outflows confused, really, it's deferred inflow though. So the answer is D. If you haven't voted yet, I recommend you do. But the deferred inflow is the thing that's like a liability, but isn't, according to GASB. So I've got my receivable booked and my deferred inflow. But this is in my governmental funds. And the only reason it's a deferred inflow is because I got it after my period of availability. If I'd gotten it within my period of availability, it would have been revenue. So hopefully that kind of made sense walking through it. And most of you got that right, so great job.
So one more here on revenues, our last polling question in this section. So reimbursement grants received after year end and after the availability period should be recorded as which of the following in the government-wide statements. So same question as question 6, but now we're in the government-wide statement. So revenue receivable, revenue and deferred outflow, a receivable and deferred outflow, or a receivable and deferred inflow. So now we're in the full accrual basis statements. Naturally, the availability period doesn't matter anymore.
Right. So yeah, we've left the land of modified accrual. We have no period of availability for our government-wide statements. So I think we all know that we still have a receivable, right? So the real question is, do I have a revenue or not? If I've in my government-wide statements for this. And everybody's doing a really good job on this question. And this is going to explain why you're going to have a reconciling item in this situation between your two statements.
So we're a little under 50% voted. So again, please make sure to at least pick one so you get your credit. You can tell April moonlights as a professor because she doesn't like her questions to be too easy. She's working on that bell curve to make sure not everyone gets them right.
Yes, I think my teaching gig is making my webinars more painful.
Just about 80%. So I'll just give the answer and then we'll close it out. So you still have a couple more seconds left. But the answer is it is a revenue and a receivable, and the full accrual statements. The period of availability doesn't matter. The timing of when you receive the payment doesn't matter. It's that it's been earned, so it's a revenue and a receivable. So a couple last slides for April.
Yeah, and then we can shake it up with a new voice for you. So subrecipients, again, if you're a tier 1, this won't matter to you, but any other recipients who got it through their state or umbrella government, or if you are a government who passed it on to other governments, not-for-profits, things like that, you really need to make sure in any grant, but CARES Act specifically, is it a subrecipient? And there's a lot of great tools out there to figure out whether something is a subrecipient or a vendor. Generally, if you're giving it to another government, and in many cases a not-for-profit, you really want to make sure if you think they're not a subrecipient, I would make sure you look up the guidance and make double sure, because you may need to, if they're a subrecipient, you're going to really need a subrecipient agreement. You're going to need to monitor them, and they are going to need to remember that they now have to, if they have spent the right threshold. As a little foreshadowing to our single audit section, they're going to be required to follow a lot of single audit requirements as well. And that expense-driven eligibility requirement is for CARES Act specifically, is met for the recipient when they pay the subrecipient or third party, regardless of when the subrecipient expends the funds. So you can have a subrecipient who has spent the money, but you haven't paid them yet. You may not even have an agreement with them yet. You need to have the agreement in place and pay them for you as the higher level local government or state government to record your revenue if it meets all other eligibility requirements. So GASB also, in that, again, that technical bulletin is full of it's very short, but chock full of useful information. They address, because if you've worked with CARES Act funding, we got new guidance on a weekly basis for a while, and it changed, and they, sometimes in surprising ways. So they said, what if we get new guidance, especially if it crosses our fiscal year? Do we have to change our accounting? Oops, didn't you go back? I think you fixed. And GASB clearly addressed that. They said that is going to be covered by GASB 56, which is one that hasn't gotten a lot of attention as a GASB statement. And it says that you only worry about the accounting for the transactions based on guidance issued during that fiscal year. So if your fiscal year ends September 30th and on October 1st, the Treasury comes out with new guidance that changes something about the CARES Act retroactively, you do not go back and change how you're doing the accounting. You consider whether it's big enough to be a subsequent event that you need to disclose but not recognize in your statements. And so you really don't have to, for your accounting for your fiscal year that has already closed, you don't have to worry on a daily basis of checking the Treasury website for the purposes of your accounting for your prior year transactions, if that makes sense. So. And then they also address, again, this is all from that technical bulletin, great resource. They address, it kind of feels like the pandemics might be an extraordinary item, right? I mean, it's 1918 was the last big one, doesn't seem frequent. Well, GASB doesn't agree. If you follow GASB, or maybe you're not all as much of a nerd as I am, which is probably good for you. If you follow GASB, they probably don't think anything's an extraordinary item. In fact, they're getting rid of the whole concept. But GASB and Technical Bulletin 2020-1 has said that they think, because apparently they're the CDC, that it's likely that they will recur in the foreseeable future, and so it is not infrequent. So it's interesting. I mean, I'm glad they gave us the answer and that we can have some consistency in practice, but it's kind of depressing that they're like, nah, this is the new normal. So I'm glad GASB is not the CDC. I'm gonna hope for better times. So it's not an extraordinary item according to GASB, and it's clearly not a special item, because special items differ from extraordinary items in that they must be in control of management, which, as far as I know, no local government has anything to do with causing the coronavirus disease. So it is, according to GASB, not an extraordinary item, and according, I think, to most practitioners, would not be a special item either. So again, I refer you back to that TB 2020-1 if you have anything to do with CRF, CARES Act accounting or auditing. It's very short, easy to read, and has a wealth of information in it. It also has some good stuff about the provider relief fund, so I recommend it. And that is it for me. Thanks, everybody.
Thanks, April. And feel free, if you do have questions based on April's portion, go ahead and you can ask them through the question panel within your go-to webinar control panel, and we can get back to them in the office hours section at the end. So now we're going to have Brian Hall join us for some PRF discussion. So welcome, Brian.
All right. Well, thanks, everybody. This is Brian Hall, partner in the enterprise office. And we're going to talk here. So we're shifting gears. We're talking about the provider relief fund. So we're now to the pool of money that was handed out to healthcare providers of nearly all types. And I will give a quick caveat that the slides were formalized a week ago. And as you may have seen, on January 15th, we got another curveball. So some of these slides have already been antiquated, but we'll go through that. So when we talk about the CARES Act, the Provider Relief Fund reporting, anyone who received $10,000 or more is going to be required to report on the use of funds to the HHS website. The portal did, it says should here, it did open on January 15th, with the big caveat that all you can do now is register for it. So you do need to go through and register for the portal, but you cannot put in your numbers at this point. That third point, the original due date was February 15th. However, as of January 15th, they have extended the reporting with no time no window has been set up. So basically what they've said at this point is go through and register for the portal, make sure that you have access to it, and then they will let us know when we're able to go back through the portal. So no real time frame there. They blamed it on the launch of funding that went out. I don't think that has anything to do with it. I think, quite honestly, it has to do with the changing administrations and people leaving HHS and new people coming in. So hopefully this will get ironed out here in the next month, but we'll see how it goes. With the stimulus bill that came through right there around around Christmas, there was a few things in the stimulus bill that actually were codified into federal law, which means they made their way into the Federal Register, that were very helpful to healthcare providers. The biggest one, of course, is that you can now, when you're quantifying your lost revenues, you can compare them to your pre-pandemic adopted budget. And when they say pre-pandemic, it has to be a budget that was in place before late March of 2020. And the portal is going to require that the CEO of the organization attest under penalty of law that that budget is the actual budget. So they obviously want to narrow down on fraud, make sure that people weren't just kind of working the numbers, so to speak, and creating a budget after the fact to show that gap. The flexibility is there now. A lot of this guidance kind of went back and forth throughout the year. The flexibility is there now in moving the general distributions among subsidiary control groups. Note that it says general and not targeted. Targeted distributions still need to land or need to be reported on where the money landed, but the general distributions can be moved among a controlled group. And it is a little more complicated than that, but that option does exist. And also the expensing of capital items. This again had gone back and forth, but if it is very COVID specific, some examples in there in the guidance, you can expense it all in 1 year. You don't have to just claim depreciation. So obviously the goal here is to, very clear from a congressional standpoint, is to give providers every opportunity to use up this funding without having to give it back next year. David, do you have the slide to move forward? All right, perfect. So this is what we know based on the portal, and I wish, when we wrote the slides, we thought we were going to be able to see the portal on the 15th and tell you what it had in it. Of course, that didn't happen. So all we're telling you now is based on the guidance that's out there, but you have to consider your expenses first. So to put it another way, if you're an entity that had lost revenues that would exceed the amount of PRF funding you've got, you still have to consider expenses. Even going into the process, you're not going to have to give any money back. They still want you to show expenses first. That makes a lot of sense when you kind of think of it from a political standpoint, from a politician standpoint. They're going to want to frame this as how many jobs did you keep or did you create? So they have to have a story to tell. They don't want you to be able to say that you used it all in lost revenues. They want you to be able to say that you used it on expenses and retaining jobs. So you'll see that when you get into the portal, whenever it opens, you're going to see that theme of creating and retaining jobs, just like in the payroll protection loan. You're going to see that throughout. The portal is going to ask for statistical information as well as dollars. It's going to ask for, if you use lost revenues, it's going to make you show the revenues by payer. It's going to ask you a lot of statistical information about volume. And it's going to ask you about your FTEs, your jobs. These last two bullet points, if you get into the port, there's some entities that are actually in a position where they may not have enough qualifying expenditures and lost revenues to justify the monies. If you're in that boat, you want to consider all the hidden expenditures related to COVID in the staffing. So there'll be a lot of them that are very easy. The capital items, very easy. The lost revenues, relatively easy to quantify. The personal protective equipment, relatively easy. But there's a lot of hidden costs in there related to COVID. The staffing, just about anybody that has a nursing staff or any direct contact with COVID-related patients is going to be paying more this year than they've ever paid before. There may be some kind of a risk-associated payment to employees. Maybe using travel nurses. So there's a lot of these expenditures that are in there. And then you can also go further. There's administrative time. I'm sure you've got your physicians and your frontline healthcare people are having to spend a lot of their time meeting and getting education and learning about the virus. At your C-suite, your CEO, CFO, medical officer, et cetera, are probably having weekly, perhaps daily calls and meetings over the virus. All of that is incremental costs related to COVID that can be claimed. So I would encourage you to just kind of, obviously, live within the rules that they've set up, but throw, net as wide as you can to see what all expenses land in there. And then finally, on the executive compensation, just keep in mind you cannot claim anything more than 197,000 and change. So if you're, and that includes 2 allocation. If you end up and you opt in your organization to allocate a percentage of, this person's time was related to COVID, allocation, especially if it's a physician or a CEO or somebody that's going to be making well over that limit, the base for that allocation has to stop at $197,000. Go ahead, Dave. Again, this is a little bit antiquated now because of what they did on the 15th. But there was a 30-day window to complete your reporting on January 15th. As of now, we don't know when that portal is going to open. If I had to guess, I would say it's probably going to be in February. And I would guess that the 30-day window you will see that, especially since we have another window in June 30. Anyway, that was a tight window. Now who knows where to land. The reporting, it says on here, obviously February, that who knows where that's going to land. But this reporting is going to be the basis for the single audit. So this is very important, and there's a lot of confusion out there. So if you are a fiscal end before December 31st of 2020, so if you are December 31st, 2020 year end, then it's normal. You're going to have single audit. If December 30th fiscal year end and before, then you do have a 2020 single audit. However, that single audit is going to be done in calendar year 21. And the whole reason for this is the feds are passing the buck to the CPAs. And the way they're doing that is they delayed the single audit. This is in the history of the United States, as far as I know, this has never happened before. They delayed the single audit so that they can require us as CPAs and you as recipients, us to audit the reporting that you're about to do on HHS. So that timeline makes sense when you kind of think about what they're trying to do. They're passing the audit requirement to the CPAs. Another kicker in there that's very interesting is that the HHS reporting is based on receipts. So they say if you received 10,000 or more. Obviously, the GAAP accounting for revenue recognition, as you know, is based on expenditures, when you get to recognize the revenue. So there is going to be a disconnect in a lot of cases between your financial statements. Your audited financial statements are going to show one number as revenue, and your HHS reporting is going to show a different number. And that's going to be another unusual, perhaps unprecedented circumstance. But anyway, so you'll have your 2020 single audit will be done in 21, and then I told us what's going to happen with the 21 single audits, but it's very likely that if you have a June 2021 reporting requirement, that'll be your 21 single audit, which will also be 21. So in the 21 single audit, you'll have 20 and 21. So we just mentioned that again. There's a lot of confusion out there, and a lot of people are saying we don't have to do a single audit this year. You do have a single audit requirement. It's just the timing of it is going to be in 2021. If you're a calendar year end, fiscal year end, you move forward just like you always would. There's an extension, an automatic extension on the timing of it, so you have quite a while to get the single audit done. And then the last thing on here, the phase 3 monies, and this was the funds that you had to apply for that you may or may not have gotten. If you did, they would have been in the December, January timeframe. That's going to fall into 2021's single audit. Go ahead, Dave. As we mentioned, almost all of this is completely unprecedented, so we're all, obviously it's frustrating, and the guidance continues to change. And like I mentioned, the portal was open on the 15th of January, and literally on the 15th, they changed it. So this is very frustrating to all of us, and we appreciate everybody's patience, and we're all kind of trying to work our way through it. What I would encourage you, obviously we'd love to help anybody on the call or anybody out there with the reporting requirements and really quantifying what's out there to be claimed. Our firm has developed a proprietary tool that helps you work your way through the process. I think it's really good, and a lot of people have been using it. But whether you use us or you use somebody else, please reach for help and guidance. The information that HHS is putting out is changing so frequently, and it's so contradictory. Even right now, there's information out there that I could point you to. So you really do need to get help from either CRI or some experienced professionals to help you through this. And keep in mind that any of those costs that you pay for your single audit or for your advisory work, your legals, anything that's related to COVID, you can claim in those as well. I've said this before, and I'll continue to say this, and it actually been worse when they push the reporting portal back. We're talking about tens of thousands of entities that's going to report to HHS, and there will be most likely tens of thousands of new single audits. And by new, I mean entities that have never had a federal grant audit in the past are now going to have a federal grant audit of some form or fashion. There are not now 10,000 new CPA firms. So you can and should anticipate capacity issues with your CPA firms. I would strongly encourage you to reach out to your chosen CPA firm, be it CRI or anyone else, and just make sure that they're aware that you have an audit requirement, that you want their assistance, and basically secure your place in line. The good thing is that we've had some, the government has added some automatic extensions, which creates a little bit more breathing room. But I don't think anybody on this webinar is going to be interested in dealing with their 2020 single audit in December of 21. So please do reach out to whoever your chosen CPA firm is, coordinate with them closely, and make sure that you have your place at the front of the line. And we already mentioned that, again, the regulations are changing. Even on the 15th, they added some more guidance. So it's really, as a healthcare provider, your job is not to be keeping up with these constant changes. Your job is to provide healthcare. Our job as CPAs and advisors is to keep up with this. So please do reach out to CRI or any other firm that's qualified and that does a lot of healthcare and governmental work can help you through this. David?
So we have a polling question, and Brian, maybe while I read through the polling question, if you look at the questions that were posted, there's a couple of good ones in there for PRF specific, if you want to take a look at and answer appropriate ones.
Okay.
So question number 8. So the Journal of American Medicine estimates that the total cost of the pandemic in the United States, including loss of productivity, federal and state spending, and direct and indirect costs of response is 1.5 trillion, 4.5. See, I was just thinking about this. Reading numbers this big is kind of challenging. 1.5 billion, 4.5 billion, 2.25 trillion, or 16 trillion. So go ahead and put your guess in. How they know at this point, I think, is an interesting. Well, I guess obviously they're guessing, but how they're even able to guess is interesting.
Hey, Brian, while we're looking at this question, and I don't believe I've said hi to everybody on the call yet. This is Gwen. I'll be speaking here in a minute. We did want to clarify that for some of the for-profit organizations receiving provider relief funds, they may not have to go through a complete single audit. There is another option in the regulations that will not be quite as intense. It's not entirely clear yet what that will look like, but it's kind of a single audit light. It's referred to as a financial audit of the HHS wards. So for-profit organizations only, there is another option out there.
Yes, thank you. I should have mentioned that. Yep. And what we think that's going to look like is essentially an audit of the HHS reporting that's coming up. But then you will also have, like Gwen said, single audit light. It is going to have certain control and compliance requirements around it. So there will be, it'll taste and smell like a single audit, just not a full-blown single audit.
Okay, so we're at about 85% voted, and according to the journal, the answer is 16 trillion. We'll say we're over 2.4 trillion on the CARES Act by itself, not counting this latest 900 billion that was, oops, sorry about that, 900 billion that was authorized in December.
Yep, and that the Journal of American Medicine, obviously very substantial traded magazine. This was Larry Summers, who and another professor that did this study, but you know, who knows, that includes all-in costs, including loss of productivity. But to put it in perspective, the total U.S. GDP is about 20 trillion. So it almost cost us an entire year of productivity, you know, including the cost that we'll have going on down the line for it. So pretty amazing. David, a couple of the questions that had come in, and I'm just kind of scrolling down here. One was related to the general distribution and the spreading of the money around the control group. This was from a Courtney. Courtney, yes, that's correct. The guidance will show that you can allocate general distributions, but targeted distributions, they want to make sure that wherever that money landed, that is what's reported on, and if you can't spend it, you got to give that one back. Gwen answered the private for-profit question, I believe. And David, Gwen, do y'all see any more questions on here that I should answer at this point?
So there's one in here that says, am I required to have a single audit if I receive 1 million in 2020 and have to return 500,000 in 2021?
Okay. So the single audit requirement is obviously $750,000 of expenditures, right? So in that case, you would not have expended $750,000. However, I'd give you a strong caveat that, again, the HHS reporting was based on receipts, not expenditures. So whereas you would not have to have a single audit because that falls under the OMB, there is still a potential that your CPA firm may have to audit that reporting to HHS. We'll have to see, because that's going to fall into the 2021 element that we don't have guidance on yet. But that would be a stay tuned. Wayne, would you agree with that?
I would. That's kind of been the theme for most of this funding all year is, you know, it depends, stay tuned, and we're still waiting for guidance. Okay, so now we'll start discussing the requirements of the single audit as it applies to both the Provider Relief Fund and the Coronavirus Relief Fund. So here we've kind of talked about this bit a little already. Provider Relief Fund CARES Act funding is subject to the single audit. If you are a governmental or a not-for-profit, of course, that is typically subject to the single audit. This is just another element that will be on your CFA. There are, of course, many entities in that realm, such as governmental hospitals that may not have received funding up to enough to receive a single audit in prior years. And then the real wrinkle here is the auditing requirements imposed on the for-profit entities. And please note that the timing of the reporting of the expenditures on the CFA for governments and nonprofits as well will correspond to the reporting done on the portal. For example, a governmental hospital with year ending of September 30th, 2020 would not report any provider relief funds on its 9/30/2020 CFA. Those amounts will go on to the next year's CFA, so you'll kind of have a double year single audit at that point. Okay, now the Corona Relief Funds, this is much more like a traditional federal program as it relates to the CFA. Now, technically, the US Treasury has said that it is other financial assistance, not a grant, but it's treated in essentially the same way as it comes to the CFA and the single audit. And if you did receive those funds as a subrecipient from your state, county, city, etc., it is still considered federal assistance and must be on your CFA, and then subject to a single audit if that total CFA is over $750,000. Okay, so we'll go through kind of some general guidance for the single audit. This will be kind of high level. If your entity is one that has never received a single audit in the past, there's a lot of resources available to you. Of course, you can reach out to CRI. There's information available on our website. And there's also a wealth of information available online for a lot of this general type of information. So what is the single audit? It is a compliance audit of federal award programs. There are states that have separate single audits. We deal with Florida a lot, of course. North Carolina has a similar one, as does Texas. I'm sure there are other states across the country that have some level of compliance auditing, just may not rise to the same level as a single audit. And basically, the overall question that's being asked is this organization using the funds in accordance with the federal statutes, regulations, and the terms and conditions of those awards? There's also test work required over internal control, but this question right here is what the opinion for the single audit is based on. Okay, here's the current regulations that apply. The uniform guidance in 2 CFR 200 has been in effect now for quite a few years. There's 6 subparts to this and 11 appendices. If you don't have to read it, you know, it's one of those that will put you to sleep. It's definitely federal legalese. Here's some references for the states that I mentioned earlier and where their single audit guidance comes from. Those are all pretty similar to the federal. Okay. Then the kind of more useful part of the guidance that's updated every year is the compliance supplement. Certain states do have their own, such as Florida and North Carolina. Texas doesn't really have a compliance supplement equivalent, but those states do. This details the compliance requirements that apply to the grants for most of the large federal programs that are received across the country. And then there's also a section for the general rules that need to be applied pretty much no matter what, whether the program is a large one in the compliance supplement or one that's not. Okay, there was the 2020 compliance supplement initially released in August, but they did not have time to update for the CARES Act and the subsequent funding acts that occurred in the spring. So therefore, there was an addendum released right before Christmas this year. It includes sections that apply to the larger COVID-19 programs, including the Coronavirus Relief Fund and the Provider Relief Fund. There's also some additional clarifying information. I would suggest that everybody at least look at the Appendix 7 to this specific compliance supplement addendum. You can find it on the whitehouse.gov website, as well as the AICPA makes it available as a public service, kind of split out into separate small sections. So you can just find that through your preferred search engine. And that the PPE information there and the deadlines are included in that appendix. Okay, we can move on, thank you. Okay, so you've probably heard the term CIFA thrown about. So what is the CIFA or the CISA? It's included in the financial reporting as supplemental information. It is the basis for performing the single audit, and it shows the total amount expended during the audit period for each individual federal and for the CISA state program. Now, this will be affected by the Provider Relief Fund reporting, as mentioned before. The expenditures for the Provider Relief Fund may not correspond with the fiscal year. It's likely there will have to be a note disclosure to the CIFA kind of explaining what the heck is going on. Okay, next slide, please. Oh, poll question.
So question number 9, and this might be the difference in a professor and a non-professor. Gwen's questions might be a little bit easier than April's. So true or false, the coronavirus relief fund money is subject to single audit compliance requirements. So true or false?
And you know, one potential point of confusion I see with a lot of this funding is how much other funding was actually included in the CARES Act. You know, a lot of people, especially those that are not intimately involved in dealing with federal funding all the time, just think CARES Act and they assume that it's this one pool of money that they're dealing with. When in reality, there were dozens of programs either started by the CARES Act or added to by the CARES Act. As an example, the addendum that was released in December has information for 14 new or updated federal programs. Now, one of those actually has nothing to do with COVID-19. I think maybe the Department of Transportation just missed a deadline for getting it into the actual compliance supplement. But so that is 13 programs where the CARES Act and the other acts had enough of an effect that they actually required to be updated.
So we'll give everyone just a couple more seconds to answer this question. So based on what Gwen has told us so far, the answer is true. So we'll go ahead and close out the poll.
Awesome, great job. Okay, so now we're looking at the elements that would be on the CIFA and or the CISA. So CFDA, CSFA, that second acronym is specific to Florida. And also technically the CFDA is now referred to as the assistance listing number. But basically this is a numerical code that identifies both the funding source and the individual program. Clusters of programs also exist. Those are different programs that are clustered together for purposes of the single audit because they are so interrelated and similar in some cases. For example, the child nutrition cluster, you're kind of buying food and paying people to prepare both breakfasts and lunches out of that same pool of expenditures. So those are two separate programs that are clustered. The CIFA will also show the federal or state agency that's awarding that money, the pass-through agencies that are involved in getting that money down to the local government or nonprofit level, and any funds that have been provided to subrecipients out of each program. Okay, we can move on. Okay, and where do these amounts come from? Well, there is a specific section of the uniform guidance there, which describes the basis for determining the federal awards expended. And overall, the rule is that the expenditures must be reported when the activity related to the federal award occurs. Now, this is subject to interpretation for some instances, and this also means that in certain cases, expenditures on the CIFA may be reported in a different period than they are in the overall financial statements. We can move on. Okay, there's other items that may not be what you usually think of when it comes to federal awards, which is usually a grant. There are loan programs where the federal government loans money to other entities. And in most cases, those loan balances stay on the CFA while there's still a risk there for the federal government that those funds may not get paid back. So basically, they want an eye kept on those funds through the provisions of the single audit until there's no longer that liability out there. There is an important provision there with continuing compliance requirements. There are certain types of loans where they're just kind of given out, and then you have to maybe file an annual report or send the financial statements on to the feds every year. Those typically are not considered continuing compliance requirements. If there's any questions about whether a specific loan balance goes on the CFA, in some cases there's clear guidance, and others it's more of a facts and circumstances analysis. Okay, matching funds. Now, if there's a local match or a state match required while spending federal funds, that amount of the match is not considered federal expenditures for the CFA. And although the rules can vary for the states, most of the time the same rule applies at the state level. We can go ahead to that poll question now.
So question 10. So a city has received $800,000 in CARES Act funding from accounting in September of 2020. The city has identified $800,000 of expenditures during the fiscal year ended 2020 that are eligible for CARES Act. Is the city required to prepare a CFA and have a single audit? So the options are yes, no, or not unless it is expended more than $750,000 of other federal assistance during fiscal year 2020.
Some of these questions are just wordy, aren't they? I do want to point out that this is definitely talking about the coronavirus relief funds that the city would have received here. And we did also want to clarify, just related to some of the confusion we were talking about with all of the funding that's been released. The Paycheck Protection Program, while these may be considered grant revenue when forgiveness has occurred or is likely to occur, these are specifically excluded from the single audit. There is a CFDA number for those funds, but again, they are excluded completely from the single audit. And there's also,
I'm sorry, Gwen, while you're clarifying, let me clarify one more thing too. I got my hand slapped with regards to the general and the targeted distributions of PRF. I had said that you cannot transfer the targeted distributions among a control group. One of the most recent FAQs does allow that. So Courtney, who asked the question, I apologize, right? You can do that. However, I would strongly recommend that you be very careful with that, because the FAQ actually says that if you do this, you're increasing your audit risk. so it's clear they don't want you to do that, but you do have the ability to do it. And if you do so, just please keep a good audit trail. Sorry to interrupt there, Gwen.
oh, no worries. Thanks for the clarification, Brian. Anything that might bring more audit scrutiny down onto your specific organization is probably not a great thing. And just real quick before we close this poll, there was a question about the CFDA number for the provider relief funds. That number is 93.498.
So we'll go ahead and close out the poll, and the answer is yes to this question. Because they did already exceed the 750,000, then they would qualify. So they don't need to expend any other funds from option C to qualify for a single audit. Another question, right? Yeah, another question. So a city received again $800,000 in CARES Act funding from accounting in September of 2020. The city has identified $600,000 of expenditures during 2020 that are eligible for CARES, and $200,000 of expenditures in October of 2020, so after their fiscal year end. Is the city required to prepare a CFA and have a single audit for the 2020 year? So yes, no, or not unless it has expended $150,000 or more of other federal assistance during 2020.
And if anyone's picked up on the fact that maybe that reads like an April question, I have to admit, these were my questions. I don't want to paint Gwen with my professor questions.
Oh, that's okay. April, being compared to you would not be a bad thing at all in my book.
I do think this is a really great question though, April, because I think there's going to definitely be a lot of entities that have not received enough federal funds in past years and that have not had to deal with a single audit that will be, and especially entities with September 30 year ends that'll really be straddling those years where this question will likely come up quite a bit.
For sure. And, you know, missing a single audit when one is required is definitely not a good look, either on the entity itself or the auditors. And getting a surprise single audit is also not a very fun situation.
So leave it open just a little bit longer, about get a little over 80%, trying to get 80% voted at least. Again, it doesn't matter if you get it right or wrong. April might send home a note if you get too many wrong, but you can just ignore those.
Oh yeah, there definitely will be notes to parents in this process. I think.
For some of us, you might want to send those to our children instead, then they can laugh at us.
Yeah, that would definitely be the case for me. My oldest left me beyond academically about a decade ago.
So we'll go ahead and close out. The answer here is C. So because they only expended $600,000 during the year, and the CFA is expenditure driven, they would not get a single audit unless they had other federal expenditures of at least $150,000 during the year.
Okay, so now we'll kind of start discussing some control and internal control items. So part of a single audit is definitely the auditors testing the internal controls over compliance. A single audit is also always associated with a government auditing standards audit, which includes testing internal controls over financial reporting and the financial statements themselves. So this is a very important concept that underlies both the financial statement audit under GAS and the single audit. So we have a item here for controls versus processes. David, could you go back one slide, please? Cool. Okay, so a process is a series of actions. Okay, some processes also include elements of controls. So what is a control? Well, we have to get the concept of non-compliance, what we're trying to prevent. That is the what could go wrong in this situation. A control is designed to address that what could go wrong and prevent it from going wrong. Those would be the preventative controls. You know, it avoids that non-compliance or error in the first place. There are also detective controls which occur later after the process has completed that can kind of check and find that non-compliance or error for you to then go back and correct. Okay, we can move on. So controls should definitely be separately identifiable. They should be clear. You should be able to tell somebody what the control established is and how you do it. When the auditors are looking at controls, we're looking for words that typically say review, approval. We want to see duties segregated between different people. You know, the same person that's ordering supplies from Staples can't also authorize that payment to be made. That gets two sets of eyes on it, which prevents fraud or errors from occurring, which prevents that what could go wrong in that purchase. Reperformance of calculations or checks is another control, and reconciliation. A bank reconciliation performed every month is a control because somebody else's eyes are going on all of those transactions in that bank reconciliation. Okay, we can move on. Cool. So part 6 of the compliance supplement which is updated every year and available at whitehouse.gov or through a simple search engine search. Has 3 sections. This is really an invaluable part of the compliance supplement at the client or auditee level because it gives you an overall of internal controls and practical examples that can be adopted to any size entity. So this is broken up into 3 overall sections. The first is a summary of concepts that goes into detail over what internal controls are, what they're trying to do, and why they're required. There's a section for entity-wide controls, which are kind of your overall control environment, information and communication, and the things that happen at the overall entity level rather than at the individual transaction level. So be stuff like the board of directors being involved in the operations of the entity. That's an indication of an entity-wide control. There are also examples of specific controls for each compliance requirement involved in the single audit. So I find that this gives people who may not be familiar with internal controls and documentation a good hands-on way to look at this and say, you know, hey, we actually do some of these things already. We can identify them as controls, make sure they're operating every time, and then we're golden. Okay, we can move on. So another thing that controls are trying to address is the risk of fraud. Fraudsters are always trying to stay one step ahead of the game. Of course, in recent years, we've heard a lot about cyber attacks and phishing schemes and all of this, where fraudsters are trying to fool people in new ways. So the opportunities for fraud that are out there and methods used to perpetrate fraud require regular evaluation as the environment changes. This is part of the risk assessment element of internal control, which is extremely important to the functioning of each organization. The internal control system should be reviewed and updated periodically to address new fraud risks. And of course, recently, a lot of these do go into the IT realm. We can move on. Policies and procedures are also part of the internal control system, and they are required for certain areas by the uniform guidance. This is a little bit wordy for a brief presentation. They are the section of the uniform guidance there that covers some of these written policies is there. There's also plenty of information available online or through your accounting professionals. There are, yeah, sure, we can do the poll question. While we're getting ready for that, please take note that your procurement policies definitely need to be in writing. And the uniform guidance updates did occur in late 2020 that clarified some issues in procurement. There are also related to the CARES Act and COVID funding, some areas where procurement has been relaxed due to the emergency nature of some of the purchases. Okay, we're ready for the question.
All right, so this is our last polling question. So which of the following are good resources to provide accounting or single audit guidance relating to the treatment of coronavirus relief funds? So GASB Technical Bulletin number 2020-1, the Compliance Supplement Addendum, Coronavirus Relief Fund FAQs, and other guidance provided by the Treasury, or all of the above.
And as you can see here with these different types of guidance, there's really both the financial reporting side that April went through as it relates to entities under GASB and the compliance and single audit side. That applies to everybody. You know, this could be nonprofits as well that operate under FASB.
So this is our last polling question, so just make sure you get your selection in so no one misses out on CPE. So the actual answer is all of the above, or the recommended answer is all the above. There's great information from all those places. So definitely ones to check out should you have questions. Okay, so moving into office hours. So we do have some questions through the panel today, and then actually from people during registration. So I'm going to ask out some questions, and so for our 3 presenters today, anyone feel free to jump in for these questions. So a couple of these are kind of specific, but I think they'll be good for everyone to hear, just as a kind of a thought process. But so to enable social distancing at a public building, we had to use more money. We had to use more outside space, which meant we needed to install a new CCTV security system. Can the cost of this security system be charged to the CARES Act CRF money?
So this is April, and I've been, again, breathing this as a consultant for local governments on this. And, you know, anytime you have a question on eligibility, it's a good idea to get with your liaison, either with your state, if you got the money from them, or the Treasury. So as you know, the guidance is not as clear and specific as you normally get in a grant, where they're not rushing against the clock to get the money out. But in general, it needs to meet 3 basic things. It needs to have not been included in the entity's budget. So it's not money you were already planning to spend. It needs to occur between the periods of eligibility, which is March 1st, used to be December 30th, 2020, may still be if you're a subrecipient, now December 31st, 2021 for direct recipients. It needs to be related, it needs to be considered necessary by the grantee, the one who is spending the money, as due to the coronavirus pandemic conditions. And so I think you have a next, so we don't have all the facts in this question. Is it assuming that it was not budgeted, assuming that the expenditure and installation happens within the period of availability of eligibility? Then the last thing is it necessary related to the pandemic? And it sounds to me, you know, professional judgment that there is definitely a nexus to the pandemic. You're changing your practices because of the pandemic to increase social distancing. And as long as that is necessary, you feel like it is a necessary thing. And there are gray areas all over the place. So whenever you can get an opinion in writing, and we have, helping local governments, we've gotten directly with the Department of the Treasury at the United States government, and they've, on certain things like some homeless building purchases for housing the homeless, that felt very borderline. We've gotten answers from them and guidance in writing that actually I think fed into a future Q&A they submitted. So my answer to that, which is very long, it would be that yes, and if all those things are in play, yes, it is an eligible use.
Okay, the next one is the additional CDBG money subject to the same restrictions as the CRF money?
Okay, so there was quite a bit of CDBG money awarded through the CARES Act. The restrictions on these funds are more similar to normal CDBG funds. For one thing, there is a 5 or 6 year period of performance for those awards in the federal regulations. For entities that have received CDBG funds that were actually awarded under the CARES Act, most of those will be passed through another entity. So my advice there would be to refer to whatever grant agreements are in place there, or reach out to that pass-through entity for any specific questions. But in general, the rules will be more analogous to CDBG rules than coronavirus relief fund rules.
Okay. Can the internal control review of a provider's most recent financial audit be relied upon for the single audit?
So Brian, if you could kind of help me out with this question here. I am not entirely sure, but I would think not, because the financial audit that will be required for those funds is to be performed by a CPA. There may be instances where some of that work can be relied upon by the external auditors, but that is going to probably be a case-by-case basis, and we may be awaiting additional guidance there as well.
Yeah, I agree. I think it certainly helps. It doesn't hurt, but the CPAs who issue the opinion, it's going to be their responsibility for opining on the, you know, the internal audit qualifications as well. So I think it doesn't hurt, but I don't think it's anything that they can just completely rely upon.
Okay. Do you anticipate interpretation differences in allowable uses of the CRF or treasury funds by different states based upon the state auditor in each state?
So I think there's two different ways to look at this question. If you are a subrecipient of your state, absolutely. We've seen that in Florida for sure. And it's not the Auditor General, it's the FDEM, who is the agency that is acting as the grantor as we're getting the subrecipient agreement through. They have put on some definitely more strict timelines for reporting and interpretations of allowability. Now, if you're thinking about the auditor, the state auditor as coming in and being the auditor of your entity, you know, that's going to be just, and I'll defer to Gwen as well, but I would think that would be, you know, you're going to see interpretation differences from any external auditor, whether it's your state auditor general or your hired external auditor, because the guidance is not as clear due to them rushing this money out for good reason, and it being such a new funding source. When you're looking at something like CDBG money, that's been hammered through many auditors for decades. So pretty much everybody, there's very few things that are going to be borderline. And that's why if you can get something in writing from the Treasury, if you're a direct recipient, or through your tier 1 provider, if you're getting it as a subrecipient, if you get something in writing on anything that feels like it's gray, like it kind of makes sense, but you know, it's not just really obviously eligible. That would be my recommendation, is to do that in advance if you can. But we have seen a lot more of a restrictive interpretation in Florida by the tier 1 recipient for the subrecipients. I can speak to that for sure.
Next one, is CRF period of performance extended to subrecipients as well, or just to prime recipients?
So that overall original end of the period performance for CRF was December 30th, 2020. And then at the very end of the year, it was extended for an additional year to 12/31/2021. However, we have not really seen any instances where subrecipients have actually received that extension yet. That is going to be at the discretion of the state or other pass-through entity. If there is an earlier period of performance, such as the original 12/30/20 that was in the original agreement between that state or prime recipient and the subrecipient, unless amended, that is the date that would rule the period of performance.
And I'll add that in Florida, like as breaking news just last week, and it's been that long since the extension, the FDEM has provided an option of how to extend that date. So if you are a subrecipient of the state of Florida, I think they have a webinar actually tomorrow that the FDEM is putting on that option they are giving. But until that subrecipient agreement you should have in your hands is amended, that extension is not automatic.
Okay. So to claim PRF funds, does it have to be an expense that was not budgeted? For example, if we allocate G&A expenses to COVID, those G&A expenses were budgeted, but we allocated some to COVID PRF funds.
Yes, so this is from Courtney. She asked very good questions. When we're looking at the budget, I guess the short answer is no, it doesn't have to be something that was not budgeted. I think and this is just Brian Hall talking, not CRI, but I think the issue there is primarily with your capital items. You know, if the feds ever look to do an audit of your expenditures and they see that you have claimed capital items that you intended to buy anyway, that's going to be a hard sell. With your G&A costs and your staffing, obviously you would have budgeted some of that before the year ended or before the year began and before we even knew about COVID. So I don't think the budget in and of itself is a qualifying factor, with the possible exception of capital items. That would kind of be a hard sell, just in my opinion.
Let me just do one last one. Can you please elaborate more on single audit light? If we are a for-profit entity, are you saying that all we will be required to be audited for us is the HHS reporting?
Okay, so we're not entirely sure what the single audit light will look like. It is pretty definite that part of it will be auditing that reporting to HHS, because that is such an important aspect of this program. However, we are still waiting guidance on what else will be required. It seems likely that there will be a simple financial statement also audited as part of this that is really just dealing with the HHS funds received and spent during whatever period this will be, whether it's a calendar year end, fiscal year end, whenever that money is reported, most likely. But again, this is a developing area and we really won't know until HHS gives us more information. Just be aware that that single audit light will be an option and it will be less onerous than a full single audit.
Okay, thanks. And thanks everyone for the questions. There was just a couple that we didn't have time to get to, but we'll respond directly to those of you that have your questions. We'll send an email. So just some final administrative things here in today's webinar. We do hope you enjoyed today's session. We're going to do these at no charge CPE sessions, every couple of months. The next one we have scheduled will be coming up in April 13th. You can see our link to register. I will point out that the link is not live yet. All of those that are on today's session will get an email once you're able to register for this next one. The next one is titled Fiduciary Activities and Leases, A Tale of Two Standards. So these two big GASB standards that we've been talking about a while, that'll have pretty significant impact on many governments. We'll do some actually deep dives with some good examples, Q&As, and again, we will have office hours a part of that. So feel free when you register to ask your specific question, and we'll get to it during the webinar. Also point out that CRI does have a podcast. We have our It Figures podcast, all things accounting, consulting. Our first season is fully available on wherever you listen to podcasts. Season 2 is just starting now. So feel free to go on. I will say, I've been on a couple of them and my mom loves it, and how could she be wrong? So it's out there. And I would also recommend you connect with us on social media or on all the traditional social media sites. We'd be happy to connect with you and keep the conversation going. Then our last slide is our presenters. You can always reach out to them directly. And we thank everyone for their participation and attention today. Have a great rest of your day.